I'm Matthew Brandon from Grand Valley State University. Leadership and diligence, making sure you keep going. I've spent over 100 hours on the challenge alone, and not only just working on the paper, but learning things that you didn't know, or maybe you did, but you just really needed to make clear. So I would say that's kind of the biggest thing I learned. Valuation. You will be 100% wrong 100% of the time in valuation, and that's okay, but it's tough, it's hard to get to the end, and it definitely was a feat, and I think moving forward I can only get better at it. So I'm finance and marketing sales, and I love finance. I'm actually in the CFA society here, and I have a great mentor, and I would love to work with numbers and even really do valuation, maybe private equity, but I'm really just looking for the best opportunity to put me in a position to gain good experiences, and I think this competition has really helped me.
Good morning, ladies and gentlemen, and thank you for joining the Grand Valley State University presentation of Neogen Corporation. Typically, we're very conscious of the pharmaceuticals that we put into our body, but we don't always focus on the food safety that we eat and put on our plates. My name is Morgan Norwick, and presenting with me today is Thomas Preston, Tyler Peterson, Matt Brandon, and Lindsay Meister. Over the past several weeks, we've conducted an extensive analysis of Neogen Corporation. Headquartered in Lansing, Michigan, Neogen is a global supplier of food and animal safety products. They work with food, farm producers, and processors through every stage of the process, beginning at the farm gate and ending on the consumer's plate. Through our analysis, we are issuing a buy recommendation with a 52-week target price of $53.14. Backing this analysis are several key drivers, including the extensive product line of Neogen that produces high cash flows. They have a strong balance sheet indicating future growth. They have an effective merger and acquisition strategy, and also competitive positioning in the food safety markets. Neogen is split into two different segments, the first of which is the animal safety segment, which comprises 53% of total revenue. The food safety segment comprises of 47% of total revenue. Neogen uses an integrated marketing model, utilizing an internal sales force within 123 distributors within 110 countries, and they also utilize international farm supply retail chains. It should also be noted they have direct market sales in the following regions of the United States, China, Europe, Canada, Mexico, and Brazil. With that, I'll pass it on to Thomas for the economic analysis.
Thank you, Morgan. Neogen's two segments operate in the following markets: the food diagnostics product market and the animal intervention products market, each with a 12% market share. Within Neogen's main geographic regions, China has the greatest GDP growth rate at 7.5%. Wall Street analysts classify Neogen as part of the healthcare sector and the biotechnology industry. However, our regressions show that Neogen's sales growth ties most closely to the food's major diversified industry. In 2011, the United States passed a law that was its first comprehensive food safety law in nearly 80 years. This increased food recalls by nearly 3,500% in 2013. China is a powerhouse of potential for Neogen. It houses half of the world's pork, and 90% of its meat consumption isn't pork. Its population is roughly 4 times that of the United States, with a comparable growth rate. Neogen products affected by this may come from Primatech, Anapure, and GeneSeek. Now into Tyler with our financial analysis.
Thanks, Thomas. When we discuss Neogen's financials, we're discussing a company that has a high cash position with zero debt. Neogen's 2014 fiscal year yielded the company's highest revenues and net income to date while growing at a compound annual growth rate of 12%. Neogen has continued to be able to operate at this level of growth while maintaining steady margins without leveraging any debt. Currently, the company's assets dwarf their liabilities with a current ratio of 7.4. Conducting a DuPont analysis has shown that Neogen's return on equity has been driven primarily by their ability to operate with a high net margin. Recently, Neogen has been facing a steady decline of their return on equity, and this fluctuation can be attributed to their recent period of aggressive growth through acquisitions. In the past 4 years, Neogen has acquired multiple companies, resulting in a total growth of total assets of 92% since 2010, while their sales have trailed behind at a growth rate of 76%. This has significantly decreased in their asset turnover rate. While historically the company has been noted to take on a lot of responsibility, it is important to note that through all of this, they've been able to produce high operating cash flows that have sustained themselves through these periods of growth. And with that, I'd like to pass on to Matt with our valuation.
Thank you, Tyler. Our first steps to valuation were to identify comparable companies. Due to Neogen's uniqueness, identifying one firm as a whole was unavailable. Looking at Wall Street analysts, we see IDEX Laboratories to be the biggest threat to Neogen's animal safety revenues. Using a more sensible measure of valuation, we utilize the discounted cash flow to firm method. To initially assess revenue, we looked at qualitative assumptions to assign key drivers. Backed by quantitative regressions and quantitative analysis, we produced growth rates of 9.1% to 13% in 2015 to 2020 respectively. However, this does not take into account Neogen's precise M&A strategy accompanied with the synergies provided. When we do take this into account, we see growth rates of 22.5% to 15.5% in 2015 to 2020 respectively. With our conservative valuation, we see decrease in revenue percentage as we move forward. Our growth is backed by several key drivers, including the acquisition of GeneSeq and the expansions of their facilities, increasing operating production of genomic samples by 25%. Igenity has targeted dairy and cattle farmers with Neogen's 2000 acquisition of Igenity, utilizing a strategic alliance with Merck Animal Health to distribute. Acumedia has allowed Neogen to become a premier manufacturer of high-quality dehydrated culture and penetrating the industrial, pharmaceutical, biotech, food safety, and life science applications. The 2014 acquisition of BioLumex produces a wide portfolio of genomic samples and increasing general microbiology sales by 35% in Q2 of 2015. Also benefiting from this acquisition is Neogen's Solaris technology, which saw increase in sales of 17% and 16% in Q4 2014 and Q1 2015, respectively. The newest acquisition of Anapure and the acquiring of their food and veterinarian assets has allowed an avenue of economic growth potential in China. Our strongest recent revenues come from 3 acquisitions in Chemtech, Primatech, and Sarbet. We see a 29%, a 28%, and a 14% increase in revenues in Q4 2014, in Q1 and Q2 of 2015, respectively. Moving on to our discounted cash flows, we calculated a weighted average cost of capital by utilizing a 10-year U.S. bond at a 2.16% risk-free rate and a Neogen specific equity risk premium at 5.76%. Using a beta of 1.2, regressing Neogen stock to the S&P, we come to our weighted average cost of capital of 9.07%. Taking this weighted average cost of capital and the growth rate in perpetuity of 2.4%, we arrive at an enterprise value of $1.95 billion. With 37 million shares outstanding, we arrive at our 2015 end price of $53.14. I would now like to pass it on to Lindsay for our investment summary.
Thank you, Matt. Looking at investment risks, our team deemed it necessary to create a risk matrix that would illustrate potential threats associated with investors purchasing Neogen stock. The risk matrix is comprised of 2 different axes, probability and severity that the event might actually occur. With our analysis, Neogen's top-level management indications, and past historical performance by Neogen, we decided to highlight 4 different risks associated among the right side of the matrix. These include merger and acquisition strategy, Neogen's extensive product lines, Neogen top-level management reconstruction, as well as their penetration into foreign markets. For example, with Neogen's merger and acquisition strategy, because they are a no-debt firm and they have a surplus of cash available, if one merger and acquisition were to fail, this would not substantially affect Neogen's overall business entity. With their extensive product lines, Neogen has trained their employees to specialize rather than generalize. This means if they were to acquire several more products, they could either hire more employees or distribute the products evenly to still remain as a specialized firm. Also, Neogen's top-level management is comprised of older, knowledgeable, and extremely invested investors, top-level management. If there were to be an investor to step down, as of recently, perhaps their COO, this has shown that Neogen has still been able to remain as a strong business entity. Also, with Neogen's top-level management indicating that they have trained employees right below top-level management to easily and sufficiently slide into the role if deemed necessary, this has also proven that they continue their success. Also looking at Neogen's penetration into foreign markets, this has shown that with Neogen's historical performance of slowly, easily, and cautiously entering the foreign markets, that if something were to go wrong, Neogen would be well equipped and easily prepared to take on this if necessary. Now over to Morgan with our conclusion.
As you can see from our analysis and our presentation, we would like to reiterate our buy recommendation with a 52-week target price of $53.14. At this time, we would like to open it up for questions.
I want to ask you about using the current risk-free rate on the 10-year Treasury of 2.16. What do you have in your valuation model that that builds in the unknown or margin of safety of the future?
I think I can answer that. I wouldn't, for us, look more at the risk-free rate. I would look at the equity risk premium that we created specifically for Neogen, separating their revenues where they have revenues globally and taking those equity risk premiums of those countries, and we seem to justify and differentiate our risk in those.
For new acquisitions, what's their focus, more on the animal side or on the food safety side? And
Both. I mean, we're looking at a company that's similar to like Johnson & Johnson. This company, they have their hands in multiple markets, primarily the food and animal safety segments, but they're buying companies wherever they see opportunity in the market, companies that they know they can seize near their distributors and such. So I don't know if there's a primary focus in either. They're right now, I think they're trying to rebrand themselves as a food safety company in general. But overall, I don't think they're worried about attributing to either sides of the revenues. They're just buying companies that they know that they can take in the market and be effective with.
I think I can add more to that on the fact that Neogen diversifies their products for not only segments they want to make it into, animal and food safety, but they have such a wide variety, thousands of SKUs, that when a vole outbreak happens, which infects horses, they had a 34% increase just from that outbreak in revenues. So with moving into China and having their acquisition of the food safety and veterinary equipment assets there, they will be able to utilize more growth by the 500 million pigs in China. And not only the half of China's population has the pigs, each pig has 6 kilograms of feed. And Neogen also assesses the feed. So that is another way that Neogen diversifies their portfolio and builds revenue.
Now, most of their acquisitions recently, though, have been on the animal health side. Have you looked at the operating margins of the animal safety side relative to the food safety side of the business? Because if you look at their acquisitions since 2000, 28 of them, a lot of them have been on the animal side, which is lower margin business, my understanding. Can you talk about that a little bit?
So,
Most certainly. Thomas?
yep. Neogen, there's a larger market available for the animal safety market. So while there may be greater margins for food safety indeed, they have a much greater opportunity, a $21 billion market size, where Neogen has a over $950 million niche market in the animal intervention market, and much larger than the food safety market.
If you look at the regulatory environment in the U.S. relative to international, can you talk about that, whether or not it's a benefit to sales or if it hurts sales?
Yes, so less than 10% of Neogen's revenues come from products that are regulated. The only regulated products are rodenticides, insecticides, disinfectants, and sanitizers. Neogen tries to focus on products that are not as regulated as much, and they are generating revenues from the companies that are being regulated by the government. So the customers are being regulated by the government, and the FDA specifically has more authority thanks to the Food Safety Modernization Act in the United States, and that has caused an increase in food recalls and the increased desire of companies to invest in food safety.
More regulations on customers, more regulations by the government typically equates in more sales as you need to sell more test kits to like conform to those regulations.
What percent do the insiders own?
Insiders is 4.3%. It does fluctuate in between there, and the John Hargrove owns 1.3% of that.
And are they heavy on options as far as compensation goes, or how did you feel about that?
They do. And the options, they do employee options, and they also have stock options, and that is something they utilize in their business most certainly. And they have a high position in marketable securities as well, adding to their overall cash position.
If you look at sales, are their sales tied to short or long-term contracts? And is there a percentage that they'll give you as far as their overall revenues being recurring in nature?
I don't think there was any supplementary figures that they provided. And as far as they're such an extensive company with so many different product brands that, for example, we take their diagnostic test kits, which is probably one of their biggest brands, and that is a lot of the contracted work through their distributors. So in some areas, yes, in some others, no. And I don't know if we had enough information to really differentiate between the two.
I would say with their distributors is really where they find the advantage. They have 123 of them, and they have optimal pricing that really puts them in that niche to keep moving forward with them in a long period of time.
On your DuPont analysis slide in the presentation, you have a comment about growth period, recent growth period resulting in a short-term reduction of return on equity. Are you saying in your forward analysis that the return on equity is going to increase?
Increase, yes. As these acquisitional sales are starting to be realized, because right now they're investing a lot. They've made 4 large acquisitions. So, and some of the revenues from those acquisitions haven't really yet been realized by the company. So we have a lot of assets, and the sales aren't really there yet. So we believe moving forward, as the companies are more adjusted into Neogen, that it'll increase.
Exactly, a higher retention ratio right now, investing in those companies will lead to a higher ROE in the future.
You know, if you look at a lot of their M&As, quite a bit of it has been international. Have you considered the impact of the strong U.S. dollar and basically how that is going to impact sales going forward and whether or not that'll impact valuation?
Yeah. Yes. So the stronger dollar is definitely affecting the foreign revenues. However, the foreign opportunities that they have, they're still investing in those, and as the economies change, they're still growing in those markets. For example, China specifically is their greatest opportunity that they see, and with all of the interest in pork and China's new adoption of their food safety law in 2008 that they had and their World Health Organization standards that they adopted, they are showing an increased interest in food safety. And as long as the countries are interested in food safety and growing in that, and China as well has a large population, much larger, and allowing for more people to consume and more people to desire food safety out of that.
Any other inputs from the investor relations person or the CFO that you met as far as how to value the company going forward that were interesting to you?
I actually had shoulder surgery at the time of the meeting, but the information relayed was they really are focusing on international growth. 38.8% last year, and they continue to look at that as an avenue. And on top of that, Neogen is such a unique company and has been so successful growing in M&A and training successors to keep that going forward. We really think we have a solid company here, especially keeping the price attractive to investors by stock splits. They've issued 5 stock splits in the past that have really kept the price attractive for investors and keeping current investors motivated and to see potential growth there.
Did the PE seem stretched to you?
You know, the PE is very large. We're sitting at 60.6 times, and it fluctuates between there. And I think for a high growth company, no debt, not paying a dividend, I think that PE ratio demonstrates that this company will show an immense amount of growth moving forward.
From a competitor standpoint, did you find it kind of vexing to the limited amount of public competitors, and how did you handle that?
Go.
Okay, so initially we looked at comparable companies, and it's so hard to find one comparable company to Neogen. They have thousands of product lines, and there's not one whole company. You have IDEX Laboratories that's doing a lot of biotechnology. They're working with test kits, but one of the Wall Street analysts, and there's a cancer company that is compared to Neogen on the top of the list. So what we could have done, and we thought to assign a multiple to the company, was take areas of competition, the diagnostic test kits, the genomics, and try to put them all together to find a multiple and do comparable that way, but very difficult to assign a multiple.
Thanks, everyone.
Good job, buddy.